Hey everyone, welcome back to Chipstock Investor. It's Nick and Kasey.
Hey, y'all.
We're going to be talking about Synopsys in today's video, and we covered this topic extensively over on one of our most recent CSI live events. You can get access to that via a semi-insider membership. You can find that membership over at chipstockinvestor.com. Check it out.
Let's just jump right into this here and take a look at Synopsys plus Ansys revenue on a pro forma basis, as if the two companies were combined as one all along for the last 5 years. And we are taking a look at what that would look like via a chart from our friends over at Fiscal.ai, sponsors of today's video. Fantastic platform for getting all of your company research needs all in one place.
If you want to make cool charts like this one and all of the other ones that we have in this video, get 15% off any paid plan over at fiscal.ai/CSI. That discount even applies to an enterprise plan for all you pros out there. Fiscal.ai/CSI.
So really decent low teens revenue growth over that period of time. And by the way, the last 12 months for 2025, this is actually only through the end of March, end of April. So $8.8 billion in revenue, probably closer to $9 billion on a pro forma basis now. We'll find out more about this in subsequent quarters. And then free cash flow, also going back 5 years on a pro forma basis, just shy of $2 billion. Ansys has been the steady grower, but as you hopefully know from our EDA articles, Synopsys has that EDA free cash flow cycle based on customer R&D, some hardware that Synopsys sells as part of their verification and emulation platform. And so unfortunately, we're still waiting for that inflection in the free cash flow cycle for Synopsys. But at least Ansys is part of the mix now, and they are a stable grower up and to the right. Let's talk about the new fiscal year 2025 targets. For Synopsys, their fiscal year ends in October. So it's one of those confusing ones, but just over $7 billion is expected. They're going to, of course, get that little bump from Ansys from the tail end of the last quarter that they just reported and the current quarter that will end here in another month and a half. So just over 7 billion in revenue. That's why it's not more like the 8 to 9, closer to 9 billion that we showed you just a couple slides ago. Adjusted operating margin at about 37%, combining the companies together. And here is their long-term objectives that they've been outlining for well over a year now. When they first proposed this merger, they're looking for, let's just call it low teens overall revenue growth. So along the same lines of what they've had independently from each other for the last 5 years. And margin expansion, adjusted operating margin expansion from that 37% expected this year to a mid 40% range, and then free cash flow margins in the mid 30% range. So the second lever of growth for Synopsys, not just the revenue, but also the profit margin expansion. Synopsys all by itself, though, keep talking about this move to AI capabilities. The last couple of years, they've been doing a lot with generative AI and LLMs. But now we're starting to move into this period where they think agentic AI will help automate more tasks for semiconductor engineers and electronics engineers and their customers. All of that sounds fantastic, but we need to talk about the ugly truth. For the quarter, revenue was only up 14% year over year. Basically, what they called out would be the growth rate without including Ansys as part of the mix. Here is the culprit. We're going to highlight here first the EDA, the core part of the product portfolio, actually continues to grow. Here over in Q3 2025, you can see still growing at, let's call it roughly 10% plus maybe a couple percentage points year over year. So that's good. But the problem is over here in this design IP. So remember, EDA companies like Synopsys and Cadence, they're now software platforms, not just a software company, but they're a full-blown platform. And part of their platform, they've been designing and acquiring IP for their customers to do design work with, see the year-over-year decrease in sales, 463 million in design IP last year, down to 428 million this last quarter, also down sequentially. And the problem they blamed on a couple of things. Problem number one, China. Revenue coming from Chinese customers. This was not an unknown because we knew Synopsys and Cadence were restricted from selling some of their products and some of their IP to Chinese customers. A bit of a year-over-year decrease in revenue from China, from 267 million last year down to 247 million. This is total sales to China. It's the EDA as well as the IP. All other geographies continue to grow on a year-over-year basis, including in the United States. But problem number two does actually pertain to a top customer for Synopsys.
This quote is from CEO Sassine Ghazi. The second thing is challenges at a major foundry customer. And we can infer that that is Intel having a sizable impact on the year. And then the third point that he mentioned is they've made some changes in their plans, their roadmaps, and resource decisions that did not go exactly as planned. And so they're pivoting some of that IP resource and roadmap to higher growth opportunities, which we'll talk about.
Sounds exciting, though.
High growth is always a good thing to throw in when you in an earnings call like this.
Before we talk about high growth, some unfortunate decisions being made, and possibly some of this is just normal synergy that happens after there's mergers and acquisitions, but downsizing, aka restructuring.
Yeah, exactly. They said that this has been planned for a long time. This isn't a brand new development. Even before the acquisition of Ansys was completely finalized in July, they were planning on doing this restructuring, and they couldn't do that while the Ansys deal was pending, and so they had to wait until that was completely done. Once that's done, they've decided that they're going to reduce their global headcount roughly 10% by the end of fiscal 2026.
So next October.
That other highlighted point there, they're conducting a strategic portfolio review and looking to find where they're going to be spending that money and how they're going to present that to their customers for highest growth opportunities.
So probably not Intel.
Not Intel.
At least not yet.
Not yet.
So for the new guidance, maybe before we circle back to the Intel and the some of the other things going on with the IP portfolio, the new guidance does imply 15% year-over-year growth. So they are going to get a little bit of a bump from Ansys, but obviously that IP segment of the business is dragging things down. We would have expected to see more like a high teens, closer to 20% year-over-year growth rate after the deal. And then free cash flow guidance, 950 million. Again, like we showed you earlier, we still haven't hit that inflection point in the free cash flow cycle for Synopsys and the EDA cycle. Compare that with Cadence Design Systems, which had a pretty good quarter. It looks like they have actually hit that positive inflection point for their free cash flow, and they're back in a new growth cycle. If you don't know what we're talking about, check out our EDA sub-industry deep dive from earlier this year. There's just another look at the design IP, how much it fell year over year, was upwards of a third of total revenue, down to about 25% of sales. Earnings per share, free cash flow per share. Yeah, things were looking good, especially on a GAAP basis, and maybe even on a free cash flow per share basis again. And that's getting delayed, obviously, until possibly next fiscal year. Quick look at the balance sheet. So there's the debt that they took out to fund the Ansys deal. The goal here over the next 2 to 3 years is, as they raise profit margins for the new Synopsys plus Ansys company, they're going to be paying this debt down. That's going to be kind of a top priority to reduce it back down, to a reasonable amount, because Synopsys was a debt-free business for many years and was one of the reasons we slightly favored it over Cadence, but ultimately we're happy owning both. So Intel, again, we have comments on this on the Synopsys channel about the last couple of years. Intel has been standardizing a lot of its IP away from custom in-house IP and standardizing it on a platform like Synopsys. But that's obviously that tailwind for Synopsys is now over. So that doesn't mean the party's over, though, necessarily for Synopsys's IP business, right? It sounds like they're working on some other things.
Yeah, not at all. In fact, it sounds like they're doing more and more custom work. Their customers don't want just, we talk about off the shelf or merchant silicon. They don't want merchant IP either. They want this custom intellectual property, these custom design works. And so ultimately what that means is they're going to be able to charge more for that custom IP.
And so this would maybe put them, Synopsys, into a bit more of competition with someone like Rhombus. Kasey mentioned interface IP in particular. That's kind of what I hear anyways when I hear that term interface. So it'll be interesting to see how this plays out. Is Synopsys going to become sort of like the small dabbler in fabless chip design as well as just an EDA company? It seems like a lot of companies are headed that direction where it starts to make sense to co-design chips, not just provide the tools to design chips. So interesting things changing here in the semiconductor industry because of accelerated computing and AI. A lot of companies, in order to kind of keep pace with the leaders like NVIDIA, with Broadcom, and so on, need to team up to be able to bring products to market faster and actually compete. And I think we should finish off with your big takeaway and decision from all of this, because you immediately came to a conclusion after listening to the call.
Well, my conclusion was they've just added Ansys, which was a standalone basis, a very good, solid company with good revenue growth. They're just starting out, one down quarter. Intel was in the past their biggest customer, but they have a lot of room for growth still.
Yeah, a lot of customers are filling that part of the market just doesn't disappear. It's just the business is moving to someone else.
Exactly. I don't think there's anything wrong with Synopsys. That was my conclusion.
Yeah. Going back to like, I don't know, the 2010s, a lot of us got used to investing in software that was just up and to the right all the time in a straight line almost. And there's still obviously a lot of companies, software companies like that still behave that way, the subscription model. But traditionally, software isn't that type of business. And so we're back in a period of time here in the 2020s where I think we're presented with situations like this, where if things are not moving in a straight line anymore, we have to worry about product cycles and development releases again. Software companies are having to invest themselves in hardware on-prem, not just rely on a cloud partner to get all the heavy lifting done. And I think this is what's happened to Synopsys. I agree. Nothing has fundamentally happened that's uprooting them from that oligopoly in EDA. The market's just very, very uncomfortable with this. And it was at a high valuation. Whenever things don't pan out as expected with a high valuation stock, you end up with outsized amounts of volatility up and down. This may be a good time to maybe just mention also, this is why we own baskets of stocks, especially if there's no easy to perceive reason to believe one company in an industry will dramatically outperform the others. This is the case with the EDA companies. When we started investing in them a few years ago, we thought we liked Synopsys a little bit better, but it was too close to call. So we own both of them. We try to keep the amounts kind of equal, but we kind of treat the two positions as one cohesive whole in the portfolio. So like we open up our portfolio and, there's two stocks there, Synopsys and Cadence, but we actually view them as basically one position. Sometimes Synopsys outperforms for whatever reason. Sometimes Cadence outperforms like it is right now. The two stocks generally will track each other fairly closely, but not always. There's always periods like this that pop up. So that's why we do what we do and the reason why we do it that way.